What's going on, guys? Welcome back to the Good Success Podcast. I am your host, Josh Culler, and today is another special time because we are live on Facebook right now with Mr. Josh Belk, and he's actually in the house right now, so he is like sitting with us across the table right now, so you guys see the cameras everywhere. We're streaming this. We want to make sure it's in the best quality, so we're streaming this live to Facebook via the cameras, and so awesome to have you on the podcast, Josh.
Oh,
this
great
is our
to be
first
part.
time being on the podcast
Yes.
with you. I can't believe it,
Yes.
but
Look forward to it.
yeah,
It'll be great.
awesome. So
And he's live.
it is live right now. So we got a good topic to talk about today, and this is an obvious topic. I mean, you guys clicked on the video right now, but the new tax law. So I have a few questions for you. I already sent you over this list of questions that we have, and we had somebody ask a question on Facebook as well from one of our postings that we had. But before we get into it, I'm going to talk about the Good Success Mastermind. So you guys know our product, the Good Success Mastermind, coming up, and Josh is actually a part of that. So Josh is one of our key cornerstone members of the Good Success Mastermind, and we're just enthusiastic when it comes to him presenting at the mastermind. Just provides so much value to the room. Having an accountant like that deals with a lot of real estate investors is just absolutely invaluable in the room. And even when we're on these calls with our monthly mastermind calls, it's just you put so much value in it, and it's awesome. So the mastermind, guys, our next event is in February. You guys go check it out, goodsuccess.com/mastermind. It is going to be in Dallas because nobody wants to be in Chicago at the beginning of February. So that's one thing that I was happy we decided on. I don't want to be up in Chicago in February. So Dallas is where we're going to be having it. So you guys go check it out, goodsuccess.com/mastermind. It is not too late to sign up. You guys have plenty of time, so make sure you guys go check it out. You have to fill out an application there, and then we review it and go from there. So without further ado, we got some good questions here that I'm excited about for the 99.9% of people who don't understand what's going on here. We got Josh Belk to explain this. So Josh Belk with Belk and Associates, and we'll leave a link to your Facebook page and website below so that they can check it out. So we got Kevin monitoring the comments right now, so anybody that's commenting, I'll be commenting back to. Kevin will be linking everything below. So first things first, tell us a little bit about yourself, what you do, how long you've been doing that, and how you even got into that. I know you have a very interesting story, so I'd like to hear it, but tell us a little bit about yourself.
Sure. Thanks, Josh. Appreciate that. Josh Belk, owner of Belk and Associates, started the business in 1998 and grew up here in the Chicagoland area, Northwest Indiana, went to Purdue University, graduated from there. Actually went to grad school at Purdue and then did some postgraduate work also at Valparaiso University. And I did that during the early days of my practice, trying to expand my knowledge before I really started to take this thing full-time and live. Through the last number of years, our business really has focused primarily, I won't say primarily, but mostly on real estate investors. So most of our clientele is in the real estate space, either actively or passively. We have a number of our clients even that might just have 1, 2, or 3 rental properties, might do 1 or 2 or 3 deals a year, as well as their regular full-time or 9-to-5 type job. And then of course we have some very large real estate investors that are clients with us as well. So I'm an enrolled agent, licensed to practice in front of the IRS at all levels. We're able to do representation there, so we do a lot of IRS representation work as well for our clients. So yeah, of course, this whole tax law, something that my office, even Christmas Day, getting text and phone calls from clients, emails from clients, hey Josh, yeah, well, I mean, it came out, just last week. Yeah. So, and everybody's like, okay, well, what in the world do I do? Yeah. And, even this morning, on the way over, get a phone call from a client and didn't even introduce himself, what's going on with this real estate thing? And kind of a really just like, okay, in what end, kind of a vague question. But so, of course, and the media, boy, so much media information on this, and so much of it has been negative. And it's been driven very much in a negative way of, this is a bad thing, and which really isn't the case. Really, for most people, this is going to be a positive thing on an individual level. For most businesses, this will be a positive thing. Now, there are some people that this will be a negative for, especially those that live in high income tax states. Think of people that live in New York or people who live in California that are high income earners that normally would be able to kind of blow up their itemized deductions. For those people, this isn't going to be as helpful. But that's a very, very small portion of the population. So for most people, this is going to be a positive thing. For most businesses, I believe this will be a positive thing. And I think long term for the economy, this will also be a positive thing.
Fantastic.
I think it's interesting that you say that though, because it seems like if that was the case, basically what you're saying is like the rich are kind of losing out here, or so to speak. I mean, if you have a high house, if you have a house that's the mortgage is over $750,000, you may not be able to deduct some of that. If you're going to lose a lot of the deductions. Most of the people that can take advantage of those deductions that you're going to lose are going to be your higher income earners. So in a way, like it really does like not give them as much benefit as the news media might be saying that it is.
That is correct, and for a lot of those people, they're going to figure things out as well. So they're gonna structure things in a way that's going to be beneficial for them. But you're right. I mean, as far as the media, they're kind of pitching this thing as this thing is going to helpful for the wealthy. President Trump has a lot of real estate holdings, so he structured this thing to help him or help his business, and which I think is kind of demeans his character a little bit and kind of demeans what he's really trying to do and trying to help the American public. And not trying to make a political statement here, but that was kind of ultimately the goal, I think, even from the beginning of what he was trying to do, was really trying to lower the tax burden to try to really release capital, and I'll mention this in a few minutes, even overseas capital back into the country, to try to get jobs back here. To try to put more income back into the pockets of Americans, because we know better how to handle our money than the government does. And I think that this particular law will help to do that. And we don't know to what effect. Obviously, time will tell. But for the most part, at least kind of in a perfect world, things that they progress as a lot of the people who study these, study the trends, study economics, and when they take a look at this, see that it will help improve GDP. We will see positive things that come from this with an increase in jobs, with people being able to spend more of their own money on things that they find is important, and also to keep money in their own pockets, even from a savings end.
Awesome. So you guys are watching this live on Facebook right now. Make sure you go out and share this video so that it gets out and about. Josh is going to share it. I'm sharing it right now. And Tom's sharing it right now, I think. So you guys make sure you go share this video. Leave some comments below. We're not going to take live questions right now, but we will answer those. And Josh will probably be on it a little bit later on to answer some of the questions that are more simple or whatever. But anyway, so let's go ahead and get into it. So before we jump directly into this whole fiasco, I have a very specific question, because I know that we talked about this yesterday when you came to the office and helped out with some of our taxing stuff. One of our quick tip videos that we came out with when we recorded at the mastermind talked about the year-end stuff. And I know that you presented on that at the mastermind. It's very, very helpful, I know, for a lot of people in the room. But for a business now, after this whole thing happened, what is something that, because I know that you told me about the D-pad and you said that's kind of out of the picture now. So for a business, what do they focus on for year-end? Like what, excluding that, maybe explain that a little bit, the whole situation with the D-pad, and then what else should they be focusing on for year-end? Sure.
So here we are. It's late on a Saturday morning, right? And so you're kind of like, we have the year. Tomorrow's New Year's Eve, right? So we're right at close to the end of the year. So what am I going to do between now and midnight tomorrow, right? Or what can I do? So your time is very limited, and it is very unfortunate that this thing was passed so late in the year, that trying to do these last minute things. But maybe here's some things that you can possibly think about. When I was before I came over here, I stopped at a client's and popped in there, and he had a couple books there about tax saving strategies. And I started opening up and started looking through them, and I looked at them, and honestly, I said, you know what? You can almost take these things and throw these in the garbage. Because so much has changed in the last week that some of the conversations have very much changed. But many of the things are still there, some of the things that you want to consider. So let's talk about maybe about a half a dozen different things that maybe you want to consider even today before the year ends. Maybe some things maybe you can do today before the year end. First of all, think about charitable contributions. And it's something that for next year and I'll talk about this here in a minute with the increase of the standard deduction. Tomorrow is Sunday, so I'm sure some of you may go to a church, or maybe you're dealing with a nonprofit locally. They're trying to do things for the homeless. Think of the Hope and Strength project that Josh Kohler heads up here. A phenomenal organization. Different organizations out there that are trying to do things in the community. It's not too late to contribute to those. And next year, for a lot of people, unless you're giving over $14,000-$15,000 a year, starting next year, you're not going to be deducting your charitable contributions. However, in 2017, you still can. So maybe something, if you look forward and say, okay, I was planning on giving $10,000 in February, maybe you should go ahead and consider doing that today or tomorrow. And so hopping online, getting that done, because you are going to be able to take advantage of that now. Whereas for a lot of people next year, they can contribute that money, but they may not getting any sort of a benefit from it. Thinking about deferring of income. So if you have the opportunity possibly to defer income to next year, to go ahead and do that. If you're doing some billing, maybe holding off on doing some of that billing instead of doing it now. And by doing that, because next year your tax rates are going to be lower, unless you're expecting your income to be much greater into a higher tax bracket. But all things being equal, you may want to consider possibly deferring some income. There's a lot going on right now about paying your 2018 property taxes early. And my office has probably received more emails on this particular topic more than anything else. And I think it's because there's so much information on the internet about this. Do I go ahead and pay my 2018? This is on a personal end, not necessarily on a business end. But do I go ahead and pay my 2018 property taxes early? And the answer is, so many of the answers will be, is it depends. I probably should put this disclaimer out here that what we're talking about here today is educational, informational. Remember, I'm going to probably give maybe a little bit of tax advice. It's going to sound that way, but really the tax advice needs to be between you and your tax professional. So don't take anything that I say and think, well, hey, Good Success or Belk and Associates said I can do this. You really need to have this dialogue with your own individual tax advisor because your situation can be vastly different than mine, than Tom's or Josh's. So make sure that you have that dialogue going on. But talking about 2018 property taxes, prepaying those early, if your particular area you live in, now we're here in Lake County, Indiana, so they haven't been billed or assessed. But for I think Cook County, Illinois, I think you might be able to prepay in Cook County, Illinois. But the question becomes whether or not if the 2018 property taxes have been assessed and you can pay them. If both of those are the case, then yes, you can go ahead and pay them now and take the deduction now. But if you're a higher income earner, the AMT tax, by you prepaying, may end up offsetting your ability to take the deduction. So a little bit complicated, but it's something that maybe you want to kind of sit down and crunch the numbers, and maybe you want to consider. A couple other things you may want to consider: look forward into early next year. Are there some supplies that I want to purchase? And maybe go ahead and buy those now. One of the provisions of the Act is allowing for accelerated depreciation and bonus depreciation on certain items. And they actually made that retroactive back to September 27th of 2017. Why September 27th, I have no idea, but that's the date that they went back to. So you'd be able to, I was almost wanted before I came over here kind of look up on the calendar and say, okay, is there something special about September 27th? Is it some congressman's birthday or something that they decided this particular date? But anything that's been purchased from then on, you can go ahead and take advantage of the bonus depreciation. So what I mean by that is historically there's been 50%, you can take 50% bonus depreciation on certain classes of assets. Well, now you're able to take a full 100% deduction on those particular items. So you may want to look and say, okay, well, I'm planning on purchasing some new office equipment, a new file server, a new whatever in February. Maybe you want to go ahead and consider purchasing that now and be able to deduct that in this particular year. And then one thing I think I heard on the radio more than anything else today on my drive in was talking about employee bonuses. And we see some of these larger C corps doing this. I think Netflix was one that they had mentioned. The CEO had taken, I think it was $12 million additional bonus or something, right? And they did that because they did that simply because of the tax law change. And I think Comcast is another one. I think they gave every one of their employees a $1,000 bonus. I may have that wrong, but I think it's something I heard on Fox Business driving in this morning. But if you own a business, maybe you want to consider maybe possibly doing something there and taking advantage of that this year. So just maybe a few things maybe you want to consider before the next 18 hours or so before kind of the year ends up.
Now, for people that aren't 100% sure who that applies to, is that for S corps, C corps, LLCs? I mean, is that across the entire board for?
Right. When you're talking about it, right. When you're talking about these expense items, that applies to everything. It doesn't matter if you have if you're operating as a sole proprietor and you don't have an LLC set up, you just have a little thing going on, and you just need to kind of expense some items to that particular individual, to somebody who owns a C corp. We mentioned a couple of those: Netflix, Comcast. Some of your larger type businesses that they are very proactively doing things as well. Right here, butting up against the end of the year. So this applies to everybody.
Awesome.
So one thing I just don't know the details of this, and maybe you can help me just a little bit. Other than the standard deduction being raised, and you don't really have exemptions anymore for dependents, and other than the mortgage deduction that we talked about. What other deductions, at least the big items, are they taking away?
Sure. From a business end, and Josh, you mentioned it earlier, the DPAD, the domestic production activities deduction, or what's been called a Section 199 deduction, that has been removed. So something even at our mastermind, a couple masterminds ago, I presented the entire time on the DPAD deduction, and of course, as of Monday, the DPAD deduction is gone. So this is something that for real estate owners, if they're keeping inventory of real estate, this is something that they can take. Anybody that's producing anything for resale, or most anybody producing things for retail, this might be a possibility for them, and that's going to end. So that's something that's been taken away. But you mentioned, Tom, standard deduction items. Or itemized deduction items, I'm sorry. When you take a look at a Schedule A, and I'm going to get a little kind of geeky here, but when you take a look at a Schedule A, basically there are 4 sections on it. Okay, that top section is the medical. Okay, and what happened here a few years ago with the Obamacare Affordable Care Act provision, they bumped up the that base or that floor of what you could not deduct from medical expenses from 7.5% up to 10%. Okay, unless you were older, so it raised that. So it made it more difficult for people to write off any sort of medical bills. Well, with this particular law, it pushes that back down to 7.5%. So if you end up with $100,000 in medical bills one year, okay, it may be something that'll be helpful for you, but it reduces that floor of that threshold from 10% back down to 7%. And that's the first section. That's your medical cost. Moving to the second section, and that's what all the hullabaloo has been. The arguments have been going on even in Congress over what people have called the SALT deductions. Like you hear this SALT, okay, which is state and local income taxes, basically what the acronym is there. And that particular section is comprised of a few different things. First of all, it's either your state and local income taxes, and then vehicle excise tax or personal property taxes, mortgage interest, and real estate taxes. So you have those in mortgage interest. So those are all kind of encompassed right in that one section on the Schedule A. Now, what has happened with this law is it used to be those items were unlimited. So provided, so when you talk about acquisition indebtedness on your mortgage, for example, that particular amount, you could take up to $1 million. You could write off home equity lines, et cetera, and capture all that interest. So that, and then your state and local income taxes. Once again, there was no on that. There was no ceiling. So you can go ahead if you lived in a high income state and you earned a lot of money. If you're in California, for example, and you make $1 million a year, okay, and you're paying $90,000 in income tax, okay, you could write off that. You could as an itemized deduction at $90,000. Okay, now that particular section is capped at $10,000. So regardless if you pay $10,000 or $100,000 in state and local income tax, mortgage interest on your primary or secondary residence, personal property taxes, all you can deduct on your Schedule A now for itemized deductions is $10,000. Okay, so that's your second section. Your third section, you think of charitable contributions, and I mentioned this a little bit ago. Your charitable contributions, one thing that they did in that particular area is they increased the what you could write off. So it went from, because historically you think of if either as a personal on a personal end or a business, if it's a non-C corp. Okay, I can write off up to 50% of my adjusted gross income that I earn as a charitable contribution deduction. Okay, that particular number has been increased now to 60%. So if I make $100,000 a year, okay, I can, as a charitable contribution, I could write off up to $60,000. Okay, so that number has increased. Now, for a lot of people, this isn't that important to them. Okay, but it becomes a little bit more important to them now because your charitable contributions are really the only area that you can beef up, that there isn't a ceiling on, that you can take advantage of to be able to itemize. So if you're not giving, you're not going to be using the itemized deduction. You're going to be stuck with the standard deduction. Then you get into the bottom section, which are all these miscellaneous items. So you think of unreimbursed employee expenses. I have some clients, for example, that are pilots, that are truck drivers. They have a lot of things that are unreimbursed. That whole section has been removed. So all those, what they call 2% miscellaneous items, unreimbursed employee expenses, tax preparation fees, safe deposit box fees, all these other kind of miscellaneous items that were on the Schedule A have all been removed. So all you have left now are the medical expenses, anything over and above 7.5% of your adjusted gross income, your state and local income tax, mortgage interest, personal property taxes, real estate taxes, capped at $10,000, and then charitable contributions up to 60% of your adjusted gross income. So you have those particular items on your Schedule A. So if all of those combined And if you're married, filing jointly, all those combined is greater than $24,000. If you're head of household, $18,000. Single, $12,000. So when I combine those, if that amount is under those particular thresholds, whether it's 24, 18, or 12, you're going to be taking a standard deduction. If it's above that, obviously you would continue to itemize.
That's intense.
You can definitely tell that there is some give and take there, you know. So they
Sure.
definitely like gave tax breaks, but they also kind of like took away some of the.
Well, there's a lot of
situations
politics
initially.
involved, and for anybody
Sure.
that's watching this who's followed this, I think from the federal government side, and even with President Trump, very frustrated with some of these high tax states, and in kind of an unwillingness to participate as far as in the conversation. So I think it kind of ended up resulting in a way that really does penalize some of these higher tax states.
Yeah.
All right. So, let's go ahead and get directly into the topic
Sure.
now. So the next question is going to be to give us just an 1,000-foot overview of this whole Tax Cut and Jobs Act. Like, somebody,
Right.
99.9% of us that aren't sure of what exactly it is. What is it?
If you followed the presidential campaign at all, I mean, and you listen to President Trump, he's a businessman, right?
Mm-hmm.
So that's what he kind of views everything through. He views everything through the lens of being a businessman. So whether you do or don't like him, you kind of have to respect the guy a little bit for the businesses that he has built, and he's also a very benevolent man as well. And if you know anything about him, he truly does care. He has cared about the people that's worked for him. He has an honest and sincere love for them and care for them. And so when he took a look at the American people, he really honestly believed that they were hurting. And so if you went through the campaign and you saw and listened to him, you probably picked up on some of this. And one thing he consistently really pressed to try to do, beyond just the Make America Great Again slogan that he had with his hats and everything else, and it's truly what he wanted to do. And a big part of that was to try to reduce this burden on individuals and on businesses when it comes to taxes. So this is kind of something initially there was some, I guess, maybe almost rhetoric of getting to the point to where he can complete it on a postcard, and I think honestly that's what he would like to do. But obviously there's a lot of politics and whatnot that goes into it. So this is probably the best that we're going to get for now, and maybe we'll see things improve in the future. But he really, ultimately, that was his goal. So really kind of taking the tax code as it is written currently, and what are areas that can be worked on to try to help get money back into the hands of the American people. And so that was kind of the goal, and this is the product of through our legislative process of what we have. So they, when the geeks that they kind of look at this, they do honestly believe that we're going to see material growth in the GDP because of this. Of course, the initial, when you think of the CBO score, when they looked at this, I think they took a look at it and said this may cost the federal government a substantial amount of money. We don't know. We ultimately don't know what's going to happen. It probably will, maybe a little bit on the front end. Hopefully in the long term, as we see things trickle down, that things will neutralize. Maybe we'll see more of a conservative approach as it comes to politically, as far as being more efficient, our government being more efficient, try to drive costs down, just like a business would. That we'll see things improve. But ultimately, that was the goal of President Trump: try to minimize the tax burden both on businesses and on individuals. Try to get more money back into the hands of the people. And so this particular act and all that goes that's involved in it, that was the bottom line what the goal was. Simply just to get more money back into the hands of the people. And so the average individual is going to see 1 to 2% more, keeping 1 to 2% more of their money on average in their pocket at the end of 2018 than they would have otherwise.
Awesome. So the next question you've already
Partially
alluded to
answered,
it a
right.
lot.
Mm-hmm.
Is there anything else you want to add about that? So the question is, how and who will this affect? Anything else that you want to add to that you already haven't said?
Well, yeah, in mentioning that, I think we really were narrow. We talked about the itemized versus standard deduction, but there's a lot more that's involved.
Okay.
So it really affects everybody. So anybody that files an income tax return. Okay, so anybody that files an income tax return is going to be directly affected by this. And anybody who owns...
So people that don't pay taxes now, are they going to get a break?
Well, individual. When you say they don't pay taxes, right?
So there's a lot of people out there and they don't pay taxes, and for some reason they still think that they should be getting a break as well. And I just say, of course, if you look at dollars and dollars, rich people may get a bigger tax break, but like at the end of the day, like to me, it looks like the rich will actually end up paying a higher percentage of the total tax. So like at the end of the day, like I actually think the Democrats should have been pretty happy about how it ended up turning out, because at the end of the day, like the rich people are really going to end up paying a higher percentage of the total tax. It's crazy.
I don't know if that's true or not, Tom. I mean, I think we'll have to see what how this thing truly does play out. I don't know if really if that was much consideration as far as this whole fairness argument,
Right.
which I don't know if necessarily should be part of the conversation, because fairness is purely in the eye of the beholder, right?
Is, yeah.
What I perceive as fair is much different than what you perceive as fair. So fairness, like I said, is kind of, you almost have to kind of take that off, kind of off the table of really, is this fair? But is this something, if somebody who's not paying taxes, well, most everybody pays taxes. So if I go to Walmart later today, I don't like Walmart. Target, whatever store I
There
go
you
to,
go,
right?
Target.
Okay, so if whatever store I go into later today, and I go and I buy ink pens, right? I have a Good Success pen here, shameless
There it
plug.
is.
Okay,
Nice.
so a Good Success pen here, but if I go and if I buy Bic ink pens, right? I'm going to pay sales tax. Okay, so everybody, if they buy anything, they're going to pay sales tax. You think of payroll tax. So when I go through and if I get a W-2 from the place that I go and work, I'm getting a paycheck, right? And so I'm getting those FICA taxes taken out of my check, Medicare, Social Security taxes coming out of my check. So I'm paying that. So anybody that has the job or buys anything or owns property, they're going to pay some sort of tax. For smokers, they pay a cigarette tax, right? So there's taxes out there that everybody is paying. But when we talk about, I think what you're referring to more is income tax. So when we get into the income tax, there are a lot of people that don't pay income tax. So there are a lot of people with the earned income credit that will get thousands of dollars back that they didn't pay in. And that still remains. So there are individuals out there, and it is very much an income shifting philosophy that we have in our country. So where it is, in many ways, I know how much money I pay in taxes every year. I know, Tom, I know how much money you pay in taxes every year, and we pay a lot of money in income taxes. We're business owners. And as a tax professional, I do prepare, my office does prepare returns that there are people who get thousands of dollars back every year and did not pay anything in the income tax on income tax. They may have paid in maybe a couple $1,000s from their withholding at their job, but they're getting a couple $1,000s back plus $5,000 plus in the earned income tax credit. And I understand that it's individuals making a little bit more money, such as Tom and myself, and probably many of you watching this particular podcast today, that you're the one paying that. And I don't necessarily have a problem with that. I don't necessarily like it, but it's kind of one of those things that is, in a way, it's kind of helping and shifting income a little bit to those who are less fortunate. And so that provision has not changed.
That's part of what I'm saying, though. Like, actually, I think if anything, it doesn't change anything where the rich are getting this big extra tax rate. It is really, I think, actually, if you look at it, a lot of things are still getting phased out at $400,000, and if there is a group of people that are not getting as big a tax break, it's probably between $400,000 and $600,000. I'm not sure why they decided to pick on that particular scope of people, but that's just what it looks like to me because of where the thresholds lie. So
that is correct, and you're spot on there. And yeah, when I think in the initial conversation, it may have the House, I think may have been somewhere in the upper 200s. The Senate was at $500,000. I might have those backwards, so they end up settling right around this $400,000 magic number. There's a $315,000 number I'll talk about here in a few minutes. So you have these different thresholds that whether they drew a number out of a hat or how this ended up getting decided, I don't know. But for most individuals out there, the child tax credit, for example, one thing that's changed, that's $1,000 now is $2,000. Those particular credits that are refundable credits, you're going to see those lower income individuals, Tom, that you're talking about, they're actually going to see higher refunds and greater refunds because of this. And even those individuals making up to the $400,000, individuals such as you and I, that the child tax credit, whatnot, has phased out. We've completely phased out of those, and we've seen a lot of phase out. We're actually going to see some benefit from that as well.
Mm-hmm. Okay. Great.
So I don't know if you want me to continue on as far as who this affects.
Is that the primary? Like that's.
Well, the
really
biggest.
it affects everybody.
Yeah, so it affects
So
everybody.
at the end of the day, and I think me and him definitely. I'm a little bit. I'm probably a little bit more. Josh is too nice, so I'm probably a little bit more harsh on my political views maybe than Josh is, and that's okay. But it just makes me upset when I hear like just blatant lies that you see on the news media. So I'll just leave that alone. So anyways, who do you think can take the most advantage of this? And maybe, I guess we already kind of answered who it may hurt or maybe won't be able to take advantage of it the most.
Yeah, that's the next question.
Mm-hmm.
Is like, who is there a way to take advantage of this for
Sure.
business owners or even
Sure.
individuals?
Yeah, kind of what you were getting to is who does this affect? It affects everybody. And who can take advantage of it? People who plan. So it's all about planning. So, proper planning prevents poor performance. I'll leave a P out there, but it prevents poor performance, right? So the individuals, the businesses who sit down and properly plan, they're the ones who are going to be able to take the most advantage of it. Tom, the businesses here, we had some dialogue earlier on in the week, and he's like, Josh, stop by the office. We need to make sure anything we need to get done before year end, we get it done. Are we structured, ready to go for the next year? And for a number of my clients, that's been the case. It's been phone calls, it's been emails. Even a few individuals have called. Hey, how does this affect me? That's prudent. So those types of people are the ones who are going to see the most benefit. Those who plan accordingly, because this indeed does affect everybody. And it does. And even when we talk about, we're not going to talk about estate taxes here. We really put people to sleep. But even on that end, I mean, the estate tax amount that was doubled as far as what the effect is there. So it doesn't matter for the living. For those who were recently passed on, it's affecting everybody. So if we kind of run through here, I can kind of just give a really high level as far as what ultimately areas have changed. I'm not going to touch on everything, or we'd be here for 2 hours. But it kind of ramble off maybe a little bit of a list of things, and maybe some of these things will trigger in your mind of, hey, this is something maybe you should consider doing either now, or hey, this is a conversation I need to have with my accountant or my tax professional here coming up in the next within the next week or two. Maybe something that'll prompt as far as a discussion with your tax preparer as it relates to your business. But first of all, let me kind of talk about first of all individuals. We talked heavily about itemized deductions. We talked about a couple other things, but the tax rates. One thing that this particular law did change was the tax rates. We had 7 tax brackets before. We have 7 tax brackets now. That hasn't changed, but the tax rate percentages have changed. So now they're 10, 12, 22, 24, 32, 35, and the top rate at 37%. The top rate before was at 39.6%. So the rates have gone down, and then the spread between hitting the different tax brackets is wider. So when you hit the next tax bracket, it's a little bit more income before you hit the next tax bracket. So everybody is seeing a tax break. So anybody that pays income tax, they're seeing a tax break on the individual end. Things that did not change: self-employment tax still at 15.3%. SECA tax, if you have a single-member LLC, disregarded entity LLC, or a sole proprietorship, you're still going to pay that 15.3% SECA tax when you file your tax return. Or a partnership, flow-through partnership with active income, you're still going to pay that 15.3%. That has not changed. The Affordable Care Act, that mandate, something that's really a lot of people suffered from, and so many of my clients, they just could not afford this. What's supposed to be affordable health care, just could not afford it. So they just paid this penalty, and unfortunately, that is something that hurt, I think, the people, lower income people in our society more than anybody else, is this Affordable Care Act. I've seen people, my poor clients come in making $30,000, $40,000 a year. No way in the world can they afford. They're trying to keep food on the table. And talking about politics here, I'm getting a little statement here, but because they're above this, $10,000, $18,000, whatever the exemption amount was of paying the penalty, so they're having to pay this penalty, and they couldn't afford it. So it's either coming off of their tax refunds, or they owed this money and have no way to pay it, and it really, really hurt them. Unfortunately, that mandate still is in effect in 2018. It doesn't come off the table until January 1st of 2019. So it's something that's still there. So if you don't have health coverage now, it's something that, I'm going to go a little bit off of just sticking to tax here. There are other options out there. The open enrollment is closed. So if you try to go online, whatever the case may be, you're probably not going to be able to get coverage. If your employer doesn't offer it, you're not going to be able to get coverage. So you may want to consider maybe utilizing some sort of a health sharing concept. There are a lot of, if you're a believer, the three of us are, if you're a person that holds faith, and I hope you are that type of a person, that there are ministries out there that you can go to and you can participate, what they call health sharing ministries. Those are excluded, and the rates are much, much less than your traditional health coverage, and they're phenomenal. I've used them for years, and they're great. So something you may want to consider to kind of get around these, this whole, okay, I'm going to have to pay, here I am, a family of four, and and the best coverage I can get is costing me $1,500 a month. I barely can pay my mortgage at $800 a month, and so trying to make that decision of, do I feed my family or do I pay for health coverage? I don't think that's something that people should have to do.
But Josh, this is supposed to be the Affordable Health Care Act.
Yeah.
There's a secret UN before affordable.
So
Yes.
it was the unaffordable health care act?
Well, unfortunately for many, and in that same vein, I mean, there are people legitimately that this helped. And for those people that had pre-existing conditions and those types of things, it legitimately did help those people who couldn't get coverage before. But they obviously botched this thing up big time, and it really needs to be fixed. And hopefully that brighter minds than the ones that put this thing together will get together and figure out how to fix this thing. Whether healthcare should be a right or not, that's a separate discussion. But kind of going back to the fairness thing.
So going through the end of 2018, you still will need to have something in place that at least exempts you from having to pay. I mean, I know somebody who had to pay $4,500 in penalty because they didn't have the proper health care coverage that the government wanted to force them to have. So, but that's still going to be in place till the end of 2018.
That is correct. And we're talking about here at year end, you have time. If you utilize the health sharing ministry, you literally can go on and sign up. And some of them allow you to sign up right online and get it taken care of. I've had a number of my clients that I sent that direction to. Saved them a lot of money. And it is something that you're not spending money on things you don't believe in either, which is what I think is really high importance, especially if you're a person that has issues with healthcare monies being spent in areas that maybe go against your own personal beliefs. So research those items. So the Affordable Care Act, it's still there for another year. The additional Medicare tax penalty is still there. So if you're over a certain income threshold, you're still going to have to pay that additional Medicare tax. So it's still there. You're still going to have to pay it. That has not been repealed. That's still there. We talked about itemized deductions. I'm not going to kind of go back through that again.
Thank you for going through that Schedule A, though, because I think I've listened to a lot of different people talk about this new tax plan, and I haven't heard anybody go through that Schedule A. And I think you did a really good job of going through that. I appreciate that. I'm not sure everybody will, but I'm maybe a little bit more of a tax geek than some of the other people out there. But I appreciate you going.
Yeah, it may help you. If you're kind of at this point, if you kind of watch this thing on replay a little bit later on, whatever the case may be, just pull up a Schedule A online, get it in front of you, and take a look at it. Or maybe we can get a link posted underneath to the IRS website to pull up the Schedule A. You kind of just pull it up and take a look at it, and you'll kind of see those different areas, and it kind of maybe give you a little bit of a visual on how do these things really affect you. So itemized deduction issues, individual exemption for alternative minimum tax. Kind of one of these, and alternative minimum tax is incredibly complicated. But basically, every time that a return gets prepared, if an individual is making over a certain threshold, I have to complete the alternative minimum tax schedule. So it's basically two ways of computing your income tax. And it's something that's affected more and more people. AMT initially, when it was written into law, was to affect higher income individuals. And to try for those individuals that were taking advantage of certain tax favored items to guarantee they still paid what the government viewed as some fair amount of tax. But it's affected even just kind of your ordinary normal middle class families now are getting hit with alternative minimum tax. Tom, I know you were hit with it. I know I was hit with it this last year. And so it's a real issue. And for a lot of my clients, it's a real issue. So that exemption amount was increased a little bit. AMT is still there. However, the alternative minimum tax was removed in the C Corp environment. I'll mention that here in just a minute. But for individuals, there is some relief there, not full relief, but there is a little bit of relief as far as on the alternative minimum tax. So that is something else that was changed. For those individuals who liked reverting Roth IRAs back to traditional IRAs to try to do some tax favor type items, that's been removed. You can't go backwards on those anymore. I'm not going to get into that. It's kind of a topic within itself. If you're thinking about doing it, don't. The child tax credit, let me talk a little bit about that. The child tax credit now is $2,000 per child, per qualifying child, and also $500 for any non-dependent that you're claiming. So I don't think I've heard in any discussion that I've heard from any accountants or anybody has not mentioned that. But if you have a grandparent or parent living with you that's qualified as a dependent, there's a $500 credit for you there as well. But for the child tax credits, $2,000 child tax credit, $1,400 of it which is refundable. Above and beyond that is non-refundable. But for most individuals that are paying income tax, they're going to see that $1,000 child tax credit go up to $2,000. And then also more people are going to be able to take advantage of it. You mentioned the $400,000 number earlier. So individuals making more money, families like myself, who the child tax credit was phased out, Tom, you yourself as well, we're going to be able to see some benefit as well as far as with the child tax credit. We're going to see some benefit there that we have not seen in the past. So that's on the individual level. C Corps. And we're not going to spend a whole lot of time in C Corps. I'd be shocked if there are a whole lot of people listening that have C Corps. However, if you're doing some tax planning, it's maybe something that needs to be part of the conversation. So when you sit down with your tax advisor, and I hope for many of you that you keep a regular dialogue with them, but if they haven't reached out to you at all, or you're kind of getting ready to schedule your appointment, have a conversation. It may be something, especially if you have a number of businesses or different types of businesses, it may be a conversation. It's a conversation that Tom and I have had. Is this something we should consider? It's a conversation that a number of my clients have had. Do we consider a C Corp? Why or why not? But what they did in the C Corps had a graduated rate from 10% up to 35%. But now C Corps all have a flat 21% tax rate. Okay, so that's one big, huge change. And so C Corps, flat corporate rate of 21%, removal of the corporate alternative minimum tax. I mentioned that a little bit ago. It lowered the dividend received deduction. And so if a C Corp gets a dividend from another C Corp, that it has its own special tax rate. So that particular deduction rate has been modified. And then repatriation. So funds that are overseas, and it's something that even under President Obama's presidency was talked about a lot. President Trump, something really that he wanted to do is try to bring capital and assets back overseas. So there is a repatriation rate that's been put in place of 15.5% for liquid assets, 8% for illiquid assets. And I don't remember there was a number I heard yesterday. Tom and I, you and I were both on that webinar listening. I don't remember what that number was. Maybe you remember what it was, but it's a substantial amount of money that they believe is going to come over.
I think we've even heard. I mean, I've read a lot of different things on this, but it's billions, and it could be even trillion. Like it's a lot of money that could come basically right into our economy because of that.
Sure, and that'd be wonderful. I mean, the money comes back in overseas as capital that's invested here in our country, because we've been uncompetitive on a C Corp rate. We have the highest C Corp rate of any nation in the world, and so to try to lower that will make us competitive. And for years, I mean, think of the '80s. All throughout the '80s, all these countries going to Japan, and even recent years going to Mexico, going to foreign countries, just companies just getting up and moving. And of course, once again, going back to President Trump during the campaign, really pushing, hey, I want to get companies back here in the States, even here in Indiana. And we've been blessed with a very conservative governors here in recent years who really have done a lot. And now we have a president that has very much the same mindset. And so here in Indiana, we've seen big corporations move in because of tax-favored structure here in the state of Indiana for them. But now nationally, we're going to see some of that as well. And hopefully this will bring large companies back here to the states with a repatriation rate with lower C Corp rates. So C Corps, kind of bottom line, what we're looking at there.
But on C Corps, to me, I guess and correct me if I'm wrong, if you were like a backpack business, say, and you were like just traveling around the country, expensing everything, and you were a C Corp, you were only taxed at 10% because you probably didn't make much money. It actually kind of hurts that type of environment. But if you were a large corporation, you made I'm not sure what the actual threshold was that made it go from 10 to 35%.
Very minimal, very, very minimal.
So like if you are a normal running business, like that's something you definitely want to, in my opinion, I think you want to look into doing if you don't need the actual capital. Correct. So if you're willing, so for me, for instance, I have 5 or 6 businesses. Like you might want to have one of them in your toolbox or in your string of companies. That's the money you don't necessarily need. That's the money you maybe reinvest back into your businesses, and that's the money that you kind of think about as more long-term investment in the business. So I think that's something that people definitely want to consider, because even that is 21 versus 35% or 37%.
Right, and you're right, and that big if is important. So because C Corps are still, the double taxation is still there. So if I own a C Corp and that C Corp makes $100,000 net this next year, I'm going to pay $21,000 in the federal rate, and then of course we have your state rate as well. So you have those rates you have to consider. Then if I pull money out, I'm going to have to pay the income tax on my individual rate on that money. So it is still subject to double taxation. But with it being lower, you're right. If you don't need the money and it's going to stay there, and your personal income tax rate is much higher than 21%, it may make sense to go ahead and have a C corp in your toolbox. I like the way you phrase that, Tom. In your toolbox, something there that you can utilize. It gets reinvested, and you're not planning on pulling that capital out. Otherwise, once again, you're going to
be because I mean, just to make sure, if you guys aren't clear about this, in an S corp environment, whether you take the money out or not, you pay taxes on it. So because there is like a break there, or in business, I don't like it. There's a bottleneck basically there. Like if the money doesn't flow through, you don't pay taxes. In the C corp, I definitely can see there being many businesses that might want to consider that.
Right, and that's a common. You brought that up, Tom. And that's a common question I get, that when we have owners that own partnerships or own S corps, and they call me and say, "Well, I'm thinking about taking money out of my business. What's it going to cost me?" And I'll have to remind them, and we try to educate on the front end if we're working with the client of what does this actually look like, and but to remind them, and like you said, Tom, regardless of whether or not, if you have an S corp, if you have a partnership, if you have a disregarded entity, LLC, whatever the case may be, you're going to pay tax on the net income from your business, whether or not you leave the money in or you take the money out. So if your business makes $100,000 and you left that $100,000 in your business, you're going to pay that tax on $100,000 at your individual income tax rate, regardless of whether or not you left it in a business checking account or you took the full $100,000 out and deposited into your personal checking account on December 31st.
It was almost as if there was a disadvantage to any kind of corporation, and now it's gotten to the point where at least like they're looking at that. Like it's kind of like you said, Trump looked at this and he's like, what can I do to at least help some kind of the corporation so that there's some kind of relief in some kind of structure. So now, like, you still pay tax whether you take the money or not, which in an S corp environment, like, is a bad thing sometimes, because sometimes you want to leave the money in. But, you know, I know guys who made $700,000-$800,000 in a year, but they only took $200,000 or $300,000. But they had to pay tax on $700,000. Right. And sometimes the employees don't understand that. Like, they think that they just have a bunch of money, but they just had to pay a bunch of tax on money that they didn't even take. So in the C corp environment, you can definitely. It's not really an advantage now. It's almost like now they took away the disadvantage of a C corporation.
And beyond that, I think the mindset was simply just to make our U.S. corporations more competitive.
Right.
Yeah. So what we're talking about here is very important because that's what affects each and every one of us that have businesses. So something that we have to consider from a tax end. How does it directly affect me in my structure? From a more of a kind of on a macro end, what President Trump and those trying to draft this particular legislation, what they were trying to do was just simply make the U.S. More competitive, because we really had a horrible disadvantage, competitive disadvantage because of our tax rates.
Yes, absolutely.
All right, so dialing it back from just the whole spectrum of business, let's laser focus into real estate, because we have, like you said, a lot of your clients, the good majority is real estate. For good success, we like to educate the real estate market. Our mastermind is a real estate, an elite group of real estate investors mastermind. So how is this going to affect the real estate market on I would say, I don't know if we want to talk. Do we want to talk about an individual level? So if somebody, a homeowner, or more specifically about an investor?
I'm not sure we want to talk about how it's going to affect the market, because I don't know that we can really tell.
I can mention a couple things on that.
Sure. I definitely would like to know how maybe a real estate investor might want to think about.
Yeah, that may be more specific.
I actually, because when you and I were having some dialogue, and that particular, you had mentioned this. Yeah. How does it affect the market? And I'm like, well, I have my theory on maybe what happens. So I kind of did a little bit of research, right? And so you have the National Association of Realtors that feels that this is going to drive the average price of a house down by about $10,000. I don't know how they figure that. I couldn't figure.
But if you think about it, like, if you look at the whole national average, like California is such a large average, such a large percentage of the entire average. I could actually see the super high end houses. This could hurt the high end houses. But if you ask me, like the Midwest, Southeast, the areas like that, I could actually see this actually bumping those areas. So
I don't know to what extent.
Everything except for the West Coast.
Yeah. Right. I mean, let's take the West Coast out of that, and maybe New York State and Massachusetts. You take some of those specific areas out, and I think it might be a very good thing for the real estate market. But maybe.
Well, I think the bigger question is when you talk about because when you're in the real estate market, somebody eventually is selling it to the end user, right?
Mm-hmm.
So you're either selling it to another investor that's using it as a turnkey, or you're selling it to
Homeowner.
Yeah, to a homeowner who's trying to find a place to live, right? So I don't know how much they sit down and figure, okay, this new tax law, how is it going to affect the price I pay on the property that I'm purchasing? I think for most people, they're looking more at an individual finance end of, okay, this is the amount of money I'm making per month. Yeah, and can I afford this?
Right.
So I don't know really if this, because bottom line, if we're returning more money back to the people, and they have more money in their pocket, they have more money to spend on things, and real estate's included. So when I look at this particular study, which I didn't follow necessarily the logic, okay, from one organization that feels that there's going to be a drop in real estate prices, but there's really no explanation on the logic. I don't know, but I kind of think as a each of us are homeowners, right? So I kind of think me personally, how much do I sit down and am I paying $220 for this house or $230 for this house, and does whether or not I can itemize my real estate taxes or mortgage interest, how much does that play into that decision? Probably not very much. So I don't know. I think that
only the people that are on the edge of it being affordable or not. Those are the people that I would say that it would affect.
Right. Well, bottom line, it goes back to their own personal finances,
Sure. Yeah,
not necessarily the dynamics of their tax return.
Mm-hmm.
Okay. So I'm not sure how many people try to make a decision on, okay, well, I'm going to take this extra amount because I can take a mortgage for this amount, and okay, I'm going to pay an extra $1,200 a year. I'm in the 20% tax bracket. I can write that off, so therefore I'm saving $240 in income tax. I don't know how many people walk through that process
Probably
in their
not.
mind. Okay.
But now what about the real estate investor who owns rentals? I mean, it doesn't seem like
that's probably
that I could see. I actually see that it actually might help them more than anything else. They may be able to buy more house.
Well, yeah. I mean, because now you have tenants who are going to have more money in their pockets.
So rents could go up, which could actually drive like what a renter.
So it might
a
actually,
landlord
yeah,
could own for the house, or
right.
buy the house,
Mm-hmm.
be higher.
So I mean, bottom line, and so much of that when you talk about the rent
Affects
versus right. So you talk about
It's
renting
about-
versus buying. Where at some point is there going to be some easing and lending, and so there's a lot going on there as well. So much of that more is driven by banking
Yes.
than it is by tax. So if when banks kind of free things up a little bit, and banking regulations free things up for banks to lend to individuals trying to purchase a home, that does a lot more for the market and trying to drive up prices than anything else. When you talk about as long as the bankers are being tough, and then even with millennials and their whole paradigm, where there's a growing paradigm of renting versus over purchasing. So when you still have that demand in the market. Kind of all things being equal, I don't see a scenario of anything dropping, of anything going down. If anything, it's either stay stable or it can increase.
Unless it's I agree with that. The only thing I would consider is possibly the super high end houses over $750,000, over $1 million may.
Sure.
They may not go down in value. They may just not raise as fast as they have.
Well, let's be real. Probably the amount of people that are investing in properties like that.
Oh, sure. For the investor,
is
yeah.
low.
Only fix and flippers in that game may be affected.
Sure.
Okay, great. So this is going to be our final question. We got a question from Adrian Shabbat. He says, does my business qualify for the 20% pass-through deduction? If not, what do I need to do to structure it so it does? Now, I'm not sure if I think he's your client.
Yeah, I know Adrian, and great guy. And so here you go, Adrian. We're going to have this conversation. I think the last time we talked here a couple weeks ago on the phone, it was doing some other year-end type planning before this law was passed. And but
As
for
a lot of people.
right,
Happen to a lot of people.
and it's kind of one of those things. Even a client I stopped by and met with earlier this morning is kind of I told him, I said, the way that you're structured, you're going to be able to take advantage of this. There's really nothing that you need to change. And the same thing is true with, of course, knowing Adrian's situation and what he had going on there. So let me talk a little bit about this 20% and what's going on there, because this is the biggest area of confusion, but it's going to continue to be, and because the regulations have not been written on it yet. So we don't know ultimately what this is going to look like. But what we do know is that anybody that has a pass-through entity that is conducting a qualified trade or business, so there are certain areas that are excluded. for example, if there's maybe a doctor, a lawyer, accountants that might be watching this, and you're making over $315,000 a year, okay, you're going to be directly impacted by this in a negative way, but you're not going to be able to take advantage of it. Okay, so somebody has a successful accounting practice, law practice, financial advisors, hotels, for example. Okay, other areas, banking, financial consultants, whatnot. They're not going to be able to take advantage of this to the same extent that anybody else would be able to. So when you talk about active real estate investors, if you have an S corp, you have a partnership. Yes, you are indeed going to be able to take that 20% pass-through deduction. Now, ultimately, what does that number look like? We're not 100% sure yet. And the way this is structured is very, very confusing. For years, we had this D-pad. It was kind of one of those things that I computed for clients when I did the preparation and told them, here, here's what your deduction is, because trying to walk them through the process. Here's a certain percentage of your W-2 income versus your overall income, and this whole comparison, just absolutely, my client would just sit there with their eyes glazed over. Okay, and it's very much the case. I actually shared on my Facebook page and on my business page an article, a Forbes article, in a comical way, but in a very much I think a clear way, explained how confusing this actually is. Yeah. So you have these income thresholds, this $315,000 threshold. You have this 50% of your W-2 versus 25% of your W-2s that the business paid, plus 2.5% of your capital expenditures. So you have these three different variables that come into play on what the deduction is. But bottom line, if you're in a qualified trade or business, so if you're not in one of those excluded areas, you have an S corp, a partnership, some sort of a pass-through type entity, you're going to be able to take advantage of this deduction. Depending on how much money you make, will depend on how much that deduction actually is. So what I would encourage for all of you to do is, if you're kind of concerned what that looks like, first of all, we don't know what the final regs are going to be. So if you call your accountant, hopefully they're up to speed on this. If they're not, you have the wrong person. But hopefully they're following this. If they were like me on Christmas Day reading the 400 and some odd pages, but I'm kind of geeky like that, right? So hopefully if they're getting up somewhat up to speed, that way they can advise their clients. If they're dealing with businesses, if they're on the personal end, they may not be, they may not, because some of your tax advisors don't deal with businesses. They don't follow this quite as closely. But hopefully if you're a business, you have an accountant, hopefully they understand what's going on. And you can have that dialogue with them. And so once these final regs get issued, and probably we'll be able to look and say, okay, this is approximately what we're going to see your tax savings will be because of this 20% pass-through deduction. And then beyond that, making sure that your business is structured from a W-2 end. Because remember, if you have an S corp, there's still that reasonable salary for the owner provision that's still there, and that hasn't changed. So hopefully that dialogue, you've been having that dialogue, you want to know what that number looks like, and you're following that. But what needs to happen with that in light of this particular deduction? That's going to be a very valid conversation, depending on how this particular law and the regs, the rules of this particular law in application, how they end up coming out, and so once we have that and we have the complete picture, then we're going to be able to fully advise clients. But as of right now, it's just kind of, well, we know this is kind of what it looks like. We know it is going to help you. To what extent? Kind of wait and see.
Okay, but you guys heard it here, not first, but you heard it here. So, Josh, thank you so much for being on the podcast.
Sure.
I mean, this is definitely a hot topic for the end of the year, and we wanted to make sure that we got all of our community on board with what is going on with, Josh, like I said, he is a part of our Good Success Mastermind, and so, and he's the only accountant in the room, and so it's totally invaluable to have somebody like this. Reach out to him if you guys have any more questions. I'm sure that he's super excited about your questions that are going to be coming his way. So, I mean, yeah.
We'll do what we can to answer them. Go to my webpage, Facebook, whatever. My information is there. Shoot me an email, and I'll get back to you as quickly as we can as far as trying to help you out.
So, Josh, why don't you just tell us, if somebody wanted to contact you and had extra questions, or maybe wanted to possibly, I know we're not necessarily pushing, or you're not asking for more work, but if somebody did want to ask you questions, or maybe local people here in Indiana, how could they get a hold of you? What's a good way to get a hold of you?
Yeah, email. You can always email me, jbelk, JBLK, at belkassociatesllc.com. You can always reach me there. Yeah, or call my office, 219-365-9520, 219-365-9520, to kind of do the best we can to try to answer your questions, and I guess we'll take it from there.
And guys, just so you guys know, this is why you want to be a part of a mastermind. This is what keeps you on top. getting this kind of information from trusted experts is why we love pushing our mastermind. It's not just because we're an education company. That's not it. We really seriously, honestly want to help you reach your goals. We honestly want to help you. We always talk about your network is your net worth, but it's also your survival plan, and making sure that you have the group of experts that are right in your corner that can help you is huge. And I think that's one of the biggest benefits of a mastermind is having those people in the room. I think that my big takeaway, Josh, just from today is people who plan will be the people that will be able to take the most advantage of this. So make sure that you're one of those people.
Yeah, and I'm sorry.
Go ahead.
Yeah, two things on that. You mentioned the mastermind. That's invaluable. If you're in the real estate space and you're doing well, you've got things rolling. Talk about getting into a real high end quality mastermind. Of course, good success is there. I know they'd love to have you on board, and the quality of the people that are in the room for that particular mastermind is absolutely unbelievable. I know even as an accountant going in, and I don't actively invest in real estate. I'd like to, but it would lose a little bit of my focus. But when I sit there and I see the ingenuity of the individuals in the room, the sharing of their struggles, kind of coming together in almost in a groupthink way of kind of addressing, and it's beyond just business problems. Sometimes even it's even a community of sometimes of health issues or emotional issues, whatever the case may be. So it's almost like a family in a way, is invaluable. But regardless of where you're at in business, yes, plan, get a mentor, get involved in a group that's going to help you. I so many times I have people that call my office and they say, well, I set my own thing up. I set my own LLC up. I hear that all the time. I can just go online and set up my own LLC. And I hear that and I cringe. And beyond just an asset protection end, because there are certain components that they didn't do as far as to protect themselves if they were to get sued, but just beyond the potential tort issues, but into just a tax planning end. I said, okay, you went in and set this up, but do you have any idea what you're doing from a tax end? You realize when you get to the end of the year, this thing is going to cost you, and if you would have just called. Okay, and
they're educating themselves, right?
Yeah, but that's why individuals are here. That's why you have professionals in the space. Whether it's you talk about needing to work with somebody, you talk about a mastermind and working with an entity like Good Success, where you're going to get the information, the value add that you get from the amount that you spend to get to have a seat at the table. You're going to get that back. And the amount that you spend to call a professional advisor, find somebody you can afford. I had this line yesterday. Find somebody you can afford and pay them. And the amount that
I'm glad you said that, because it is education.
It is.
And you know what? Like
Absolutely.
so many people I see out there, they want to do it on their own. Yes. You're going to pay for it one way or another.
You
might
pay
as
for
well
education.
You might as well just pay for it and have a shortcut and get to your destination
Absolutely.
quicker. And that's really what it is. I mean, that's what a group like that is. It's helping you get to where you want to get faster. And thanks for that, Josh. We didn't prep for that at all, and that's not what
shameless plug.
That's not what we asked for from people to come on our podcast. But I'll tell you, even Josh is an accountant coming in, and yes, I think it does help him because he can actually see what his clients need. And so that was kind of why I wanted Josh to come in, because I thought I could help Josh's businesses as well. This is not just because I wanted to be able to help the other real estate investors, although I actually believe that this could help Josh. And I've even seen Josh's business grow, and he's getting to the point now where he has to hire more people, and I've seen his business grow because of this as well.
All right, great stuff. So you guys heard it here. Make sure you share this video out. We want to get this out and about. And check out Josh's Facebook page, his website. We have it all linked below for you guys to check out. And then we're actually going to see if we can do some quick tip videos with him after this, so we can get some more. We got to pump out a lot of content from you right now, Josh. We got you in the office, so we have to do it. So anyway, that's going to do it for today's episode, guys. Thank you so much for watching this live on Facebook. We're going to be doing this a lot more often. So we know that the Facebook Live is huge. It'll work into your algorithm a lot more when you guys go on Facebook. Make sure that in the future, when you guys do see that we are going to go live on Facebook, we will always have a link in the description for the post. You guys set a reminder for it so that you don't miss out on it. And then, like I said, you can actually go back and watch this as well. This will be published as an actual podcast, an audio podcast that'll be on Google Play, iTunes, Stitcher, SoundCloud, and Anchor, so you guys can check that out. After it has been published, we will have it linked below if you guys are watching this later tomorrow. But you guys can go check it out there on our podcast. And then also make sure you subscribe to our podcast, like our Facebook page if you have not already. And then our Good Success Mastermind. We just talked about it, but the Good Success Mastermind, we don't need to talk about it anymore. Just go to goodsuccess.com/mastermind for more information about that. You guys can check it out there. It's not too late. Our next event is in February, and we have 4 a year, once a quarter, so you guys can go check that out, sign it up, fill out the application. So, man, this is our longest podcast.
I think so.
But it is needed. Definitely needed. Very informational. You guys got a lot of information. Go back and watch it. Share this around to your friends. Josh, thank you so much for being on today. We highly appreciate it. Just such invaluable information. And we know that there's been stuff out there that people have had to pay for to listen to this, and just the fact that you're willing to share this with us on the podcast where you don't have to pay for it is, we're giving value. We want to give value to people. That's what we're all about, the community. That's why we pump out so much content, is for you guys to find value and good success and pretty much build our community up. And you talked about helping people with their personal problems too in the mastermind, and that's a community, a knit community that we like to focus on. So that's going to do it for today's episode, guys. Thank you so much for listening in, and remember, whether you're looking to survive, thrive, or matter, our goal is to provide the tools to reach your vision. Thanks again for listening, and until next time.